Miami just earned a distinction no city wants. UBS Global Wealth Management ranks at #1 worldwide for housing bubble risk ahead of Tokyo, Zurich, and every other major market they studied. The bubble risk score hits 1.73, well above the 1.5 threshold that signals high danger. Over 15 years, Miami posts the strongest inflation-adjusted housing appreciation among all cities in the analysis. The current price-to-rent ratio surpasses even the extremes of the 2006 property bubble. Homes sit on the market for 89 days as of September, 16 days longer than a year ago. Active inventory climbs 16.3% higher than September 2024. Yet 43% of all transactions close with cash, and that figure jumps above 53% in the luxury tier. The median home sells for $496,000 in July, up 1.2% year over year, while the September median list price registers for $199,900, down 4.8% from a year earlier. The numbers scream contradiction. The question is which signal matters more. 15 years of price appreciation built this moment. Miami's inflation-adjusted housing gains outpace every other major international city UBS examines. The pandemic supercharges the trajectory. Americans flood into the Sunshine State chasing warmer weather, lower taxes, and more space. Florida imposes no state income tax, and that advantage pulls buyers from the West Coast and Northeast in waves. International demand remains robust, particularly from Latin America, especially in the luxury oceanfront condo segment. The coastal appeal and favorable tax environment create a magnet effect that compounds year after year. High-profile rivals underscore the wealth concentration. Global soccer icon Lionel Messi owns 4 condominium units at the Cipriani Residences, Miami. Amazon billionaire Jeff Bezos holds 3 properties with a total value of $234 million on Indian Creek Island. These buyers can locate anywhere they want, but Miami becomes increasingly the city of choice. The migration brings wealth, spending power, and a capital base that traditional metrics struggle to capture. Mortgage rates hit historical lows during the boom, fueling demand that inventory cannot match. Pre-pandemic inventory levels establish a baseline that the market now approaches again. After years of scarcity, the price trajectory climbs steadily from post-2008 recovery through pandemic explosion, building the foundation for today's risk profile. The boom starts with real capital from real buyers creating real scarcity, not speculative froth. At least not initially. Miami's buyer composition defies conventional analysis. All cash transactions account for 43% of all deals in the first half of 2025. In the luxury tier above $1 million, more than 53% of purchases involve cash. Eli Baracha, director of the Tiber and Sheila Hollows School of Real Estate at Florida International University, explains that evaluating Miami's housing market based solely on incomes earned within the city represents a misguided approach. In Miami, a lot of the income earned here, probably more than other cities, is not necessarily reported. People are really making more money than what gets reported. As an international hub, Miami attracts a significant number of buyers who earn their incomes out of state or even abroad, before bringing those funds into the popular coastal city to purchase property. If somebody brings wealth from Brazil or any other country or another city, they're not necessarily earning the money here or making the wealth here, but they're bringing it here. For those reasons, the price-to-income metric does not apply to Miami the way it does to typical domestic markets. The July median sale price stands at $496,000, up roughly 1.2% year over year. As of September, the median list price registers at $499,900, down 4.8% compared to a year ago. International buyer concentration focuses heavily on Latin America, with particular strength in the luxury oceanfront segment. Out-of-state buyers arrive predominantly from the West and Northeast, fleeing high-tax jurisdictions. The wealth transfer pattern creates a disconnect between local Bureau of Economic Analysis income data and actual purchasing power. Traditional affordability ratios break down when the money funding purchases originates elsewhere. UBS builds its bubble risk assessment on 5 weighted metrics: price-to-income ratio, price-to-rent ratio, change in construction to GDP ratio, mortgage to GDP ratio, and city-to-country price ratio. The bubble risk scores range from below 0.5 to above 1.5. Cities with ratings above 1.5 face high risk of a housing bubble. Those between 1 and 1.5 face elevated risk, while ratings between 0.5 and 1 indicate moderate risk. and anything below 0.5 signals low risk. Miami earns a score of 1.73, boosting the Sunshine State Metro to the top of the ranking. Tokyo lands in the numbered spot with a bubble risk score of 1.59, just ahead of Zurich with a 1.55 rating. Los Angeles comes in fourth with a rating of 1.11. The index tracks 21 major cities worldwide. According to the report from UBS Chief Investment Office, the term bubble refers to a substantial and sustained mispricing of an asset, the existence of which cannot be proved unless it bursts. Typical signs of a housing bubble included a coupling of home prices from local economic fundamentals such as incomes and rents. Miami's current price-to-rent ratio reaches 20, based on a median home sale price of $635, and median rent of $32,000 to $180 annually. The current price-to-rent ratio has surpassed even the extremes of the 2006 property bubble, signaling a high bubble risk. Despite affordability for buyers being at near-record lows, home prices continue to diverge from rents. The boom has cooled over the past 4 quarters, with price growth softening. Yet the UBS authors themselves acknowledge contradictions in their assessment. While price growth is expected to turn negative in the coming quarters, a sharp correction appears unlikely at this stage. Miami's coastal appeal and favorable tax environment continue to attract newcomers from the U.S. West and Northeast, with real estate prices still well below those in New York and Los Angeles. International demand, particularly from Latin America, remains robust, especially in the luxury oceanfront condo market. The methodology identifies extreme risk, but the authors themselves hesitate to predict the burst. Affordability has collapsed under the weight of compounding costs. The median home price reaches $496,000 in July, up 1.2% year over year, while the September median list price hits $499,900, down 4.8% from a year earlier. Mortgage rates climb from pandemic-era lows starting in 2022, naturally leading to a slowdown in local real estate purchasing. Affordability for buyers falls to near-record lows according to UBS. Insurance premiums surge, driven by mounting environmental risks such as flooding and hurricanes. Regulatory changes force many condo associations to finally tackle decades of deferred maintenance, saddling owners with hefty repair bills. These combined costs prompt more owners to sell, adding pressure on the market. Days on market expand to 89 days as of September, 16 days longer than a year ago. Active inventory climbs 16.3% higher than September 2024. Delistings accelerate at a rate more than twice that of the rest of the nation. Homes throughout the United States stay on the market for a median 58 days, while Miami homes linger unsold for an additional 16 days. The cost stack comparison reveals why buyers freeze even as sellers resist price cuts. A purchase decision made during the pandemic with low rates, lower insurance, and deferred maintenance now confronts a buyer with rates that have climbed sharply, insurance that has spiked due to environmental risk, and HOA assessments that reflect decades of catch-up. Sellers possess strong financial positions with cash reserves providing a backstop for further price declines. They can afford to wait rather than accept lower offers. Inventory approaches pre-pandemic levels as slightly lower mortgage rates prompt some homeowners to sell. Days on market hit 89 days, making Miami the slowest major U.S. housing market, with the typical home waiting 16 days, longer than a year ago. The national median stands at 58 days. Miami adds 31 days to that baseline. Active inventory sits 16.3% higher than in September 2024. Mass delistings define the summer pattern, with Miami leading the nation at a rate more than twice the national average. By September, the mass delistings and languishing properties give Miami the strongest buyer's market in the country, according to Realtor.com. Yet seller distress remains low. Jake Kreml, senior economist at Realtor.com, notes that Miami homeowners have proven to be particularly patient and price-anchored despite the housing market slowdown. As evidenced by a surge in local delistings, sellers are in a stronger financial position than the 30,000-foot view would suggest, which provides a backstop for further price declines. The market may remain slow, but real estate values are not likely to crater. The 43% all-cash transaction share overall and 53% plus cash share in luxury properties create a buffer. Cash buyers don't face foreclosure pressure when rates rise or markets slow. The power of cash means that if enough people are buying with cash, that provides very big support for housing prices. Crashes happen when there is over-leveraging, where people borrow too much and then suddenly cannot afford the debt. This market isn't clearing, homes can't transact. Capital is frozen, but it's also not collapsing the way 2008 did with forced sales and foreclosures. Potential triggers could break the stalemate. Insurance premiums surge driven by mounting environmental risks such as flooding and hurricanes. Additional carrier exits from the Florida market could leave properties uninsurable or force buyers into the state-backed Citizens Insurance backstop. Regulatory changes force condo associations to tackle decades of deferred maintenance, creating hefty repair bills that saddle owners with unexpected assessments. These combined costs prompt more owners to sell, adding to pressure on the market. A major hurricane making landfall could trigger an insurance crisis that forces transactions to fail. When mortgage requirements can't be met, flood map revisions that expand high-risk zones would have similar effects. The UBS index doesn't predict exactly when prices might drop, but warns that changes in the economy, investor confidence, or a big increase in housing supply could cause home values to fall. While price growth is expected to turn negative in the coming quarters, a sharp correction appears unlikely at this stage. The phrase "at this stage" carries weight. Circumstances can change. Anna Bozovic, Miami-based real estate agent and founder of Analytics Miami, notes that the distressed property rate remains very low. Inventory still sits below pre-pandemic levels according to local experts, and the continued inflow of residents from high-tax states supports sustained buyer demand. But any trigger that forces patient cash-back sellers to liquidate quickly, whether insurance unavailability, catastrophic storm damage, or sudden capital needs, could create the feedback loop where inventory spikes, transactions fail, and prices must adjust to find clearing levels. Local experts fire back hard against the UBS methodology. Baracha argues that the ranking is biased because the price-to-income metric is not applicable to Miami. In Miami, a lot of the income that is earned here is not necessarily reported. Being an international hub, Miami has a significant number of buyers who earn their incomes out of state or even abroad before bringing those funds into the city to purchase property. If somebody is bringing wealth from Brazil or any other country or another city, they're not necessarily earning the money here, but they're bringing it here. For those reasons, the price-to-income metric fails to capture reality. Bozovic goes further, accusing the Swiss bank of using Miami as clickbait and spreading sensationalist misinformation. The report fixates on the pace of price growth, which is a deeply reductive lens. It never once mentions Miami's extremely high level of all-cash buyers, 43% overall, and above 53% in the luxury tier. Ignoring that fact while labeling the market a bubble shows a complete misunderstanding of Miami's fundamentals. The UBS index also overlooks Miami's very low distressed property rate, inventory still below pre-pandemic levels, and the continued inflow of residents from high-tax states, all of which support sustained buyer demand. In reality, Miami's housing market is not driven by speculative debt or unsustainable leverage. Prices are supported by real capital, strong domestic and international demand, and limited supply. The UBS report completely failed to recognize these fundamental truths and turned Miami's success into a tragically misconstrued headline. Krimmel frames the situation differently. It was not a bubble bursting, but rather the air slowly coming out of the balloon. The silver lining of Miami's dynamics is the market has been cooling in a slow and controlled way, rather than a 2008-style crash. Yet the experts defending Miami dismiss signals that deserve attention. The price-to-rent ratio reaches 20 based on a median home sale price of $635, zero and median rent of $32,180 annually. That ratio surpasses even the extremes of the 2006 property bubble. Affordability sits at near-record lows. Days on market stretch to 89 days, 16 longer than a year ago and 31 days above the national median. Miami earns the distinction of the slowest major U.S. housing market and the strongest buyer's market in the country. The UBS authors note internal contradictions. They label Miami the highest bubble risk globally, yet predict no sharp correction, but local boosters have their own blind spots, dismissing valuation extremes and liquidity problems as temporary noise. The stress distributes unevenly across submarkets. The luxury tier above $1 million sees more than 53% of transactions close with cash. International demand, particularly from Latin America, remains robust, especially in the luxury oceanfront condo segment. Jeff Bezos owns 3 properties with a total value of $234 million on Indian Creek Island. Lionel Messi holds 4 condominium units at the Cipriani Residences Miami, ultra-luxury. Enclaves like Indian Creek Island remain insulated from rate and affordability shocks because all cash. International buyers dominate transactions. These buyers can be anywhere they want. But Miami becomes increasingly the city of choice that brings here more wealth and spending power. Condo markets face the most acute pressure. Regulatory changes force many condo associations to finally tackle decades of deferred maintenance, saddling owners with hefty repair bills. Insurance premiums surge driven by mounting environmental risks such as flooding and hurricanes. Oceanfront properties carry particularly high insurance costs and face the most severe environmental exposure. Older buildings with deferred maintenance confront assessment bombs that can run into tens of thousands of dollars per unit. These combined costs prompt more owners to sell, adding to the pressure on the market. The condo segment shows the clearest signs of 2006 level stress, where carrying costs have exploded beyond what many owners anticipated or can sustain. Mid-tier single-family neighborhoods see inventory pile up and days on market expand, but benefit from cash buyer support at rates lower than luxury, but still elevated compared to national norms. The 43% overall cash transaction share provides a floor even in segments where affordability has collapsed for finance buyers. Active inventory climbs 16.3% year over year, but sellers refuse to capitulate on price, pulling listings instead. Miami leads the nation in delistings at more than twice the national rate. The mid-tier experiences the freeze transaction stall. Liquidity disappears, but not the crash. At least not yet. 6 to 12 months from now, conflicting predictions collide. UBS expects price growth to turn negative in the coming quarters, though a sharp correction appears unlikely at this stage. Baracha expects housing prices to probably stay roughly where they're at, slightly higher, perhaps slightly lower as part of the process. He doesn't expect housing prices to spike and doesn't expect them to fall significantly. Krimmel argues the market has been cooling in a slow and controlled way, rather than experiencing a 2008-style crash. The market may remain slow, but real estate values are not likely to crater. For buyers, the checklist starts with verification. Confirm insurance availability and cost before making offers. Carriers continue to exit Florida, and premiums surge for environmental risk. Assess HOA and condo assessment risks, particularly in older buildings where decades of deferred maintenance now require catch-up. Confirm cash reserves or financing locks, recognizing that rate volatility and insurance requirements can kill deals late in the process. Understand liquidity risks in a market where the typical home waits 89 days for a buyer, 31 days longer than the national median, with Miami holding the strongest buyer's market in the country. Negotiating leverage favors purchasers willing to move decisively. For investors, this isn't the 2008 over-leveraged scenario where foreclosures cascade and forced sales dominate. The 43% all-cash transaction share overall and 53% plus luxury cash share create downside protection. Sellers are in stronger financial positions than the surface view suggests, providing a backstop for further price declines. But a frozen market creates opportunity cost. Capital sits idle in properties that can't transact, generating no return while carrying costs rise. The risk isn't collapse but stagnation, where years pass with flat to negative price growth and minimal transaction volume. The data recaps tell the story. Miami earns a bubble risk score of 1.73, ranking number 1 globally ahead of Tokyo's 1.59 and Zurich's 1.55. All cash transactions account for 43% of deals overall and above 53% in the luxury tier. Days on market hit 89 days, 16 longer year over year. Active inventory climbs 16.3% higher than September 2024. The price-to-rent ratio surpasses even the extremes of the 2006 property bubble. The current median list price registers for $199,900 as of September, down 4.8% year over year. Miami holds the slowest major U.S. housing market and the strongest buyer's market in the country. Yet Miami's coastal appeal and favorable tax environment continue to attract newcomers, with real estate prices still well below those in New York and Los Angeles. Whether this qualifies as a bubble or just a balloon slowly deflating, Miami's market has fundamentally changed. The days of pandemic-era appreciation and rapid transactions are over. What replaces them? A slow grind lower, a prolonged freeze, or an eventual clearing at sharply lower prices depends on factors still in motion. Insurance markets, environmental events, migration patterns, and seller patience all remain variables. The UBS methodology misses critical dynamics. Local boosters dismiss legitimate warning signs. The truth sits somewhere between the alarmism and the denial. Act accordingly.